Okay, so let's cut straight to the chase. In my view, the ideal portfolio should tick the following boxes. It should be well diversified across global markets, have low annual fees, be easy to manage, so you can essentially set it and forget it, and most importantly, it should be tax efficient. These are the main things that we'll consider when building this portfolio. And as you'll see, there are many ways to achieve this. Some methods are more hands-on but cost-effective, while others are simpler but come with a higher cost. Ultimately though, any of these strategies should give us the best chance of reaching our financial goals and potentially becoming millionaire. Okay, so let's start off with a few assumptions. Who is this portfolio for? I assume that for most people in their 30s, their main goal is quite straightforward: long-term capital growth. This means that to achieve steady wealth accumulation over time, the most important step is committing to invest every month as soon as you get paid. Now, since our main goal here is to maximize growth, for me, that immediately excludes a couple of different investments. Firstly, we'll be leaving bonds alone. Bonds have been historically safe places to get some easy interest, but for us, stocks is what we'll be focusing on, as they have tended to offer the best returns long term. Secondly, if we do get any income, we'll get it reinvested as soon as possible. And thirdly, we're not going to complicate our decision-making process by investing in individual stocks. We'll stick with index funds and ETFs. Okay, so to get started, the goal is to construct a portfolio that covers most of the world's markets as closely as possible. This means that wherever the growth is in the next 5, 10 or 20 years, we'll be able to make sure that we get the fair returns of that growth. In the investing world, the global investable markets can be broken down into the following categories, and with these weightings. So with this in mind, the first approach is to find funds we can use that correspond to each region of the world. And of course, we want to stick to low-cost passive funds for this portfolio, as we want to keep our costs as low as possible. First up, the largest stock market, the US and the rest of North America. For this part of the world, I've chosen the Vanguard FTSE North America ETF. It's got 637 companies inside of it, and it's got a fee of 0.1% per year. Next up is the second largest market, Japan. For this, I will be choosing the Amundi Prime Japan ETF, as it's really cheap and well diversified with 300 stocks inside of it. Another option here is the Vanguard Japan ETF, but it's 3 times more expensive. Next up, we need to deal with the UK and Europe. This is one that we could make simpler by just having one single European ETF that includes the UK. But because we're trying to make this as low cost as possible, it will be a tiny bit cheaper to select a fund for each region. So for the UK, I've gone with the Vanguard FTSE All Share Index Fund, but another very close choice would have been the FTSE 100 ETF. However, there are 2 reasons as to why I chose the All Share Index Fund. Firstly, it's got the FTSE 100 inside of it, but it also invests in those smaller and mid-cap stocks for a total of 575 stocks. And secondly, it's cheaper than the FTSE 100 at 0.06% per year. This one is up to you, and it obviously depends on whether it's available on your investment platform. But if it's not, the FTSE 100 is really a good choice anyway. Moving on, we have Europe, which is an easy one to cover off. The fund I chose here is the Vanguard FTSE Developed Europe excluding UK ETF, since we went for a separate UK fund. This has 446 companies inside it with an ongoing charge of 0.1% per year. Moving on to the final 2, for the emerging markets, the cheapest one I have found is the HSBC MSCI Emerging Markets ETF. It's got a total number of 1,443 holdings and ongoing charges of 0.15% per year. And finally, last but not least, we need to include the Asian market, but without Japan, since we chose a separate fund for that. For this one, I've chosen the LNG Asia Pacific excluding Japan Equity ETF, which includes 149 companies and it costs 0.10% per year. The alternative here would be this Vanguard fund, as it's more diversified, but it's also more expensive. Again, this one is up to you. So here is what the portfolio looks like with all of the weightings I've allocated to each one. The total fee across all of the funds is only 0.10%. And here you can see the weighted fee for each fund. Now, I did say that we wanted a simple portfolio, but this one may seem far from that. But my point here is that there is nothing stopping you from investing in different markets by yourself to weightings that suit you. You don't necessarily need to follow these allocation percentages. So this would be for someone who wanted a more hands-on approach and likes customizing things. But here is the second way of constructing this portfolio. From an investing perspective, the global stock market can be broken down into two major parts: the developed world and the emerging markets. The developed world makes up approximately 90% of the global stock market, while the emerging markets account for 10%. Therefore, we could simply use the Vanguard FTSE Developed World ETF with the ticker symbol VHVG and allocate 90% of our money. And to cover the emerging markets, we can use the HSBC MSCI Emerging Markets ETF, which has the ticker symbol HMEF, and invest the remaining 10%. By investing in these two funds, your money will be invested in thousands of stocks from almost every country in the world, and all of this for only 0.12% per year. So this portfolio will essentially earn you the same returns as the previous DIY portfolio, and it's also very easy to manage since it's made up of only two funds. Now, if you want to keep things even simpler, you could just pick a single global fund that covers all these markets in a single investment. Here are some of the cheapest products available to UK investors. The main thing to consider here is whether you like to include the emerging markets into your portfolio or focus entirely on the developed world. For example, the first fund on this list captures only the developed world, which, as we saw, makes up 90% of the total investable universe. So it does leave out the emerging markets, but look at how cheap it is. Many people might argue that it's worth sacrificing the potential extra returns from the emerging markets for this very low fee. But if you do want to include emerging markets, there are many options on this list that are very cheap as well. All of these are very solid options in my opinion. If you're just getting started, I personally think that the global fund is the best approach because it prevents you from tinkering with your investments. Okay, next up, let's head up to building a portfolio for people in their 40s. But just before we continue, do me a huge favor and hit that subscribe button if you're enjoying this video. Investing in your 40s can seem a bit more complex than when you start off investing at a younger age. Not only is your timeline closer to retirement, meaning you have less time to see your investments grow, but someone aged 48, for example, will have a very different set of needs to someone aged 32. So the first thing to consider is what your priorities are for the money you intend to invest. I'm going to assume that for most people, the main goal will still be to maximize the growth of their investments. If you have an investment timeline in mind that is longer than 5 years, then this is probably going to be your main focus. Therefore, you won't be surprised to know that the investing strategy here and the portfolio doesn't have to change at all. Keeping a broadly diversified global index fund or taking a hands-on approach in building a global stock portfolio is still the way to go in my opinion. You still have plenty of time in this age bracket, but the most important thing here will be to maximize your contributions. In theory, you are now at the top of your career pay-wise, so make the most of it. The key is to keep investing consistently and not overthink things. As an example of how much your investments could be growing over time, if you invest £350 each month for the next 30 years with an average annual return of 10%, which reflects the long-term average for global stock markets, your portfolio could grow to £798,000. If you're also able to increase your yearly investment in line with the inflation rate, it could potentially reach £1 million. Lastly, it's worth mentioning that ideally you'd want to have all of these funds inside the stocks and shares ISA to protect you from both capital gains tax and dividend tax. It's a very tax efficient way to invest, so you may as well make the most of it. Now, the most important thing here is to avoid some basic mistakes that could seriously harm your investment portfolio. So watch this video next to find out what they are and how to avoid them.